There was a lot of speculation and investor angst about what a U.S. debt default might mean for the global economy. But ultimately, the economy never really skipped a beat, and financial markets, for the most part, never truly panicked. In fact, there were a number of positive developments for investors during the quarter that were most likely overlooked due to the debt ceiling. So we thought it might be helpful to revisit some of those, as well as refocus on what's going to drive markets now that the debt ceiling is behind us. We'll start with the economy and inflation, as the two are closely linked. After all, the same tools that global central banks are using to bring inflation back down are expected to also result in slower economic activity. The hope is, of course, that central banks will be able to engineer a soft landing in which inflation gets back to acceptable levels while the economy avoids falling into a recession. Central bank track records at accomplishing this task aren't particularly good, so some skepticism here is understandable. With that said, there have been a number of positive data points that are giving investors some hope. On the inflation front, this first chart is Citi's Inflation Surprise Index. It measures data points relative to market expectations. Inflation pressures have been expected to ease with time, but this shows that inflation has actually been falling faster than the market anticipated. That's clearly a good sign. Another good sign at this time is that the drop in inflation has not been accompanied by a similar drop in economic activity. This second chart, where readings above 50 and in green are positive indicators for growth, shows that most countries are still seeing growth, and in some cases, like here in the US, that growth is even accelerating. To be fair, not all the data is positive. Economists have noted weakness in commercial real estate and tighter bank lending standards. But from a big picture standpoint, inflation is falling and economic activity is holding up. That leads us to the Fed. The Fed has slightly disappointed investors recently with talk that the fight against inflation is far from over and they might need to raise rates more than just one more time. But after moving rates from effectively 0 to 5% in just 15 months, whether they do one or two more small rate hikes may not be all that consequential. Again, looking at things from a high level, the bulk of the actions the Fed is going to take are behind us. Market sentiment, or how positive investors feel about future returns, can also be viewed in a positive light. Investor sentiment tends to be a contrarian indicator, and as this graph from Goldman Sachs shows, investors at the end of May, just before the debt ceiling deal was reached, were largely bearish or negative. Sentiment improved once the debt deal was reached, but a survey like this tells us that many investors likely still had plenty of cash on the sidelines. Lastly, when it comes to valuation, which our investors know is really what drives our process, there are still reasons to be optimistic. Even with the equity market rebounding more than 20% since last fall, we're still finding good value in several markets. As shown here, not all markets are the same though. While many small and mid-sized companies and international companies still trade at discounts to longer-term averages, the U.S. large-cap market is back trading at a small premium and is no longer quite the deal it was just 9 months ago. That note about U.S. large-cap stocks leads us to our next video, where we'd argue that this chart doesn't really tell the full story about what we're seeing there.